Welcome. Today we're talking to Jack Lowenstein from the Morphic Global Opportunities Fund. Welcome, Jack. How did you go in November?
We had a pretty good month. We were up about 5% in absolute terms, and we outperformed the market by about 50 basis points. So, for us, that's a good return, obviously a very good return for the investors. And it means that now we've outperformed the market by a small amount since we launched. Now, we are a long bias, long short fund. By and large, that means that we expect to struggle to keep up in a very strongly rising market and try and capture our performance during a down market. We've really only seen up markets since we launched 2.5 years ago. So for us to be ahead of index in that period is probably as good as we can hope.
When you're talking about performance, you're talking about performance against the MSCI. Of course, you've significantly outperformed the local Australian market. Well,
one of the things that we hope we're offering investors is an alternative to be invested in Australia by investing in global equities, but in a framework that is very much risk managed. So we're trying to take some of the volatility that comes out of the natural process of investing in a currency other than your own.
And compared with October, November was a relatively calm month on world markets.
It certainly was a relief. I mean, October was that very sharp V-shaped month where you were down 6% in the first half and up 6% in the second half, whereas October was November was more of a gentle glide upwards. But it had its own kind of little shock within the month, which was the sharp fall in the oil price. The oil price has been falling for most of the time since about the middle of the year, but it really fell off a cliff towards the end of the month, and that really highlighted a few anomalies in the market, if you like. Particularly the fact that energy stocks underperformed sharply, and stocks that were associated with consumption of other goods and services, where people were going to have more money to spend because they're having to spend less money on petrol, really did very well.
So what was the fund's exposure to the oil market?
Well, we've been exposed to the energy sector pretty well for the last year or so. We haven't felt very excited about it. We haven't felt that we certainly didn't predict it was going to fall as sharp as this, but we didn't feel it was going to do that well, and so it turned out.
Where were the fund's largest gains made during the month?
I think the most important thing to say is we actually didn't have many losers. So we had lots and lots of fairly small winners and not many losers. We made money in our UK water utilities trade, where there's more and more expectation that there will be some kind of corporate activity, which is something we've been predicting. And also people are recognising that the UK water utilities trade on a dividend yield that's really much too high compared to UK gilts, given that they're kind of like growth bonds with a little bit of growth but a very steady income stream. We made some reasonable money in the US in two particular areas. One was our US banking stocks, and the other was AMP, not Australian AMP, but US AMP, which is a business rather similar to Australian AMP, which does life insurance, financial planning, funds management, and offers a wrap business. And then we had a few wins in Japan, particularly in our auto stocks. We own Mazda and Mitsubishi Motor, and they both did quite well, particularly Mazda. And then we had some one-off gains, particularly in a company called Soda Sanayi, which is a Turkish chemical maker, makes chemicals for the glass and detergent industry. And we had really quite few losers. I think we lost a little bit we underperformed a bit in one of our Japanese stocks, which is a leasing company called Century Tokyo Lease. And we made some money on hedges we put in place for interest rate changes. So we believe interest rates are going to rise in the US and fall in Australia, and both those trades made us some money as well.
And how did the fund perform on the short side, Jack?
Most of the shorting we did during the month was really to hedge our positions, so we didn't have any spectacular wins in shorts. We did make some money from a trade we had on where we thought that UK betting shops would struggle under new regulation, which proved the case. And we had a short position on a Japanese supermarket chain, which we think is very overpriced. And we hedged that short position with long positions on two regional supermarket chains. So we were short the national player and long the two regional players.
What were the disappointments for the month?
We had, as I think one of the things that really stood out in November, we had absolutely no disasters. And as I said, the worst thing we could say was we had this underperformance of one of our Japanese stocks, which didn't fall, just didn't rise in line with the market.
By the end of the month and looking forward into December, how was the fund positioned?
We were fully invested. As I say, we've got these hedges on through the interest rate markets. And we really do have more and more conviction that interest rates will start to rise during the second half of the year in the US. But we also think that the rapid deterioration of the Australian economy means that there will be interest rate cuts in Australia quite soon. Now, the effect of that is that we expect the currency, the Australian dollar, to continue to weaken. And as a result, we're completely unhedged. We have no hedging back into the Australian dollar. And whereas at the end of last month, we had a small hedge position hedging for further falls in the yen, which we hedged back into the US dollar, we don't even have that trade on. So we have no real conviction on any currency pairs, but we do feel that overall the US dollar will continue to appreciate and the Australian dollar will fall. But we feel the best way to really to capture that is through interest rate trades.
What do you make of the outlook for 2015?
We're working on that at the moment. I guess there's always two elements to that. What trends that were established during 2014 are going to persist in 2015? And there we're really talking about US dollar strength and the continuing recovery of the US economy. And on the other hand, what's going to change over what trends will break. And we think that the main point of inflection, if you like, and we're not quite sure which way it's going to go, is at what point the Europeans do manage to expand their monetary base and really put some life back into the European economy. Because European stocks are now quite cheap, there is a prospect that if there's any confidence about improved or softer monetary policy in Europe actually being achieved, there could be quite a sharp recovery in Europe. So that's the main trends I think we think. Continued strength in the US, possibility for a theme break, if you like, in Europe.
Jack, thank you for your time. We look forward to talking to you again next month.
Thank you.